Something extraordinary is happening in the world of investing. The Oracle of Omaha, Warren Buffett, is sending a silent but unmistakable warning to every investor. His actions are screaming louder than his words, and yet most people are completely missing it. Right now, Buffett is sitting on an unprecedented $325 billion cash pile, the largest in Berkshire Hathaway's history. To put this into perspective, this amount exceeds the GDP of countries like Finland or Chile. It's 6 times larger than what Berkshire held during the 2008 financial crisis. But why? What does Buffett see that others don't? Buffett has always maintained cash reserves as a safety net and ammunition for opportunities. But this time, it's different. This isn't just caution, it's preparation for something monumental. Buffett's famous market indicator, the ratio of total stock market capitalization to GDP, has reached an eye-popping 208%. For context, during the dot-com bubble of 2000, it peaked at just 140%. Before the 2008 financial crisis, only 110%. Today's levels demolish those previous danger zones. When stocks collectively trade at more than double the value of all goods and services produced in the entire country, we've entered uncharted territory, and Buffett knows it. During Berkshire Hathaway's annual meeting, Buffett hinted at potential tax changes coming. But beneath this practical explanation lies a deeper message about overvalued markets and economic instability. Perhaps the most alarming signal comes from Buffett's recent actions regarding Apple, Berkshire's largest holding and one of his most celebrated investments. In recent quarters, Buffett has been systematically reducing his stake in Apple, selling billions worth of shares. This isn't a minor portfolio adjustment, it's a strategic shift. Apple once represented $178 billion of Berkshire's portfolio, but over the past year, he's reduced his position by more than 2/3. Why would someone like Buffett scale back on one of his best investments? The warning signs don't stop there. America's debt-to-GDP ratio now sits at 120%, creating enormous financial pressures across the economy. Buffett understands the ripple effects this creates: higher borrowing costs for governments, businesses, and consumers alike. Elevated debt levels combined with sky-high market valuations form a dangerous cocktail. And then there's interest rates. After years of near-zero rates fueling asset inflation, we're now in a fundamentally different landscape, with rates at their highest levels in decades. This shift is a paradigm change for businesses that thrived on cheap money. Companies that loaded up on debt during the low-rate era now face refinancing at much higher costs, a reality that threatens their profitability and stock valuations. To truly understand Buffett's defensive positioning, we need to look back at history. In the late 1990s, as tech stocks soared to unprecedented valuations, Buffett refused to participate in the frenzy. Critics said he'd lost his touch. But when the bubble burst, his cash reserves allowed him to strike legendary deals, while others were forced to sell at fire sale prices. The same pattern repeated in 2008 when his $44 billion cash reserve seemed excessive until it wasn't. Today, Buffett's positioning is even more defensive than during those crises. His cash reserves are larger, his selling activity is more pronounced, and his warnings about market valuations are more urgent. But there's another layer to this story: market concentration risk. Today's market rally has been driven largely by just 7 tech giants, the so-called Magnificent Seven. These companies now account for nearly 30% of the S&P 500's total value. This extreme concentration creates systemic risks that Buffett has seen before. And then there's artificial intelligence, a transformative technology akin to automobiles in the early 1900s. Buffett acknowledges AI's potential but remains cautious about assuming today's leaders will dominate tomorrow. In the early auto industry boom, over 2,000 companies entered the market. By 2009, only 3 American car companies remained, and 2 went bankrupt during the financial crisis. So what does all this mean for you as an investor? When someone with Warren Buffett's track record takes such dramatic defensive positions, it's not just caution, it's a call to action for prudent investors. The lessons are clear. Stay vigilant about valuations. Diversify your portfolio and prepare for potential turbulence ahead. What do you think about Warren Buffett's warning signs? Share your thoughts in the comments below. And don't forget to subscribe for more in-depth analysis on financial markets and investment strategies.